Right. Hello again, everyone. This is the second project for Finance 695, should I say the final project. My name is Ryan Myers. It's the project on the company analysis for the class. And the background is just for you, Dr. Cresson, since you always make fun of me with my LSU football shirts. All right, let's go over the objective real quick. Wanted to analyze these 18 different companies associated with our classmates. It's from their companies, what they do, their world. So wanted to determine which company that I felt was the best choice to invest in, and ultimately why. The analysis criteria that I examined were the return on equity. The DuPont analysis, which is a breakdown of the ROE. I wanted to really see, what was driving that ROE. The equity multiplier, how much leverage or risk is the company taking. The economic value added and profit margin. For references, mainly I use Bloomberg, Morningstar, Yahoo Finance. These are sites and programs that I know nobody else used. Get some really good info. Computer's kind of slow. All right. So let's touch on the key ratios real quick. ROE is net income over total equity. It measures a corporation's profitability by revealing how much profit a company generates with the money that the shareholders have invested. And then you go into it a little bit further and do the DuPont analysis, which the breakdown would be the tax burden times the interest burden times the operating margin times the total asset turnover times equity multiplier. Now, operating margin is what revenue is left after paying variable costs. The total asset turnover is the ability to use assets to generate sales. Let's see, equity multiplier, real quick, is the total assets over total equity. This measures a company's financial leverage based on its total assets and total equity. Companies can make more profit by financing purchases of assets either through equity or debt. Would be your creditors or your shareholders. Economic value added is net operating profit after taxes, or your NOPAT, minus your capital times cost of capital. This ratio here measures a company's financial performance based on the residual wealth calculated by deducting cost of capital from its operating profit. The profit margin is net income over revenues, measures how much a company keeps in earnings for every dollar of sales. Obviously, a higher profit margin indicate a more profitable company that has better control over its costs compared to its competitors. So these are key ratios whenever you're deciding what companies to invest in, what to look at. High ROE. Leverage, good leverage, risk shows that a company's taking some risk, making profit off of that risk, and high profit margin. So let's get into the companies that I analyzed. All right. Here's all the logos from each company. I'll just run through real quick and tell you the companies that we have, the 18 companies. Monster Beverage Company, Deere & Company, Intuit, Coca-Cola, Chicago Bridge and Iron, AT&T, Caterpillar, Valero, Fluor, Marathon, Autodesk, Jacobs Engineering, URS, Community Health, CenturyLink, Tenay Healthcare, Gentiva, and Amedisys. These, like I said earlier, these companies cover most of the industries that our classmates are in, which made it a little interesting. All right off the bat, what I did was I went in Excel. I listed out the ROEs for last 4 years, and basically I just sorted them from largest to smallest for the last 12 months. As you can see, the top 5 being Monster Beverage, Deere & Company, Intuit, Coca-Cola, and CB&I, or Chicago Bridge and Iron. Okay. Let's move right into Monster Beverage Company into more detail, and then I'll move into the other top 5 companies. All right, let's talk about Monster real quick. Monster was leading marketer and distributor of energy drinks and alternative beverages. So taking a closer look at their ROE, as you can see, from 2010 up to 2012, 2013, they have had steady increase, steady growth in their ROE. It doesn't really alarm me that the last 12 months has gone down a little bit, slightly. So their DuPont analysis breakdown, kind of look at what's driving their ROE. As you can see, their operating margin is 31.4, which is really good. They were actually the highest ROE and the highest operating margin of the 5 top companies. Their total asset turnover shows that they're managing their assets pretty efficiently, being over 1, and they were also had the highest asset turnover as well. Their equity multiplier is 1.4, which it shows sufficient leverage and risk. That could be higher, but as long as it's over 1, they've got some debt which they're hopefully making profit off of. Moving into Deere & Company. Deere & Company, real quick, manufactures agricultural, construction, and forestry machinery, diesel engines, drivetrains used in heavy equipment, and lawn care equipment. As you know them, John Deere Green. A look at their ROE from 2010 moves up to 2012 and then starts to decrease again in 2013 into the last 12 months. Now, this also doesn't alarm me too much, but it is kind of a big factor that it goes substantially up to 44 and drops down to 34. So that's definitely something I'd want to keep my eye on a little bit longer, maybe, before investing in them. Their DuPont analysis breakdown driving their ROE. Let's take a look at their operating margins at 15. They're the second highest ROE, and their operating margin is the third highest, which is still very attractive. Their asset turnover, however, is not very attractive. It's at a 0.6. Under 1 means they could probably work on managing their assets a little bit better, and try to work that number up. Their equity multiplier it sets off a little bit of alarm. It kind of goes hand in hand with these other ratios that it's 5.7, which means I think they have too much leverage, maybe not enough equity, retained earnings. That I'd like to see that number a little bit lower, because I just don't know if they're making the profit that they need to off their risk. Next, we'll discuss Intuit. Intuit is a software company that develops financial and tax preparation software and related services for small businesses, accountants, and individuals. In looking at their ROE, it goes from 21 up to 29, and then falls to 27. You know, kind of like the last two companies, that small slight fall to 27 doesn't set off any alarms. It seems to be okay, although it's not as high as Deere and Monster. It's still a big player, and obviously it's the top 5 in rank. Now, if you look at their DuPont analysis breakdown, look at their operating margin as -10. Now, this -10, you know, it's not good at all. Basically, also, I mean, their asset turnover is under 1. They're not managing their assets correctly. They need to be more efficient, and you know, their equity multiplier does look okay. It's not too high, but you know, maybe they need to lower a little bit of risk and maybe try to put some more money in equity. You know, maybe purchase a little bit more assets, maybe become a little bit more liquid. I'm not too sure on this one. It doesn't look right. Okay, let's discuss the Coca-Cola Company. Their ROE, man, 2010. Well, before I go into that, we all know what Coca-Cola Company is. The world's largest beverage company, refreshing consumers with more than 500 sparkling and still brands. Everybody knows the red Coke emblem. And now, if you're lucky, you might pull one with your name on it. Woohoo! Those taste a lot better, by the way. 2010 ROE for Coke is high. Significant drop to 2011. Kind of levels off from 2011 all the way to 13. The slight drop in the last 12 months. It's not a big deal. But I'm just kind of wondering what the big drop was. In looking at their, I'm going to jump to asset turnover. You can see it's under 0.5, which means it's telling me that they need to do a lot better job of you know, managing their assets, being more efficient with their assets, and what they're doing with their assets. Their debt's a little bit higher than other companies. You know, I really don't think it's too high, but 2.7, 2.78, it could be a little bit lower, but it looks okay to me. The operating margin's pretty high. It's actually the second highest of the top 5 companies. So, you know, in that aspect, they're doing okay. Let's look at Chicago Bridge and Iron real quick. CB&I designs, engineers, and constructs some of the world's largest energy infrastructure projects, providing EPC solutions and proven technology. Looking at their ROE, it does have a steady increase, which is good. Their breakdown, there's low numbers on their DuPont analysis. They were the 4th highest operating margin of the top 5 companies. Their asset turnover looks good, though. They look like they're managing their assets efficiently. Their debt is pretty high, their leverage. So, you know, I think they could lower their leverage and possibly help them out. All right, as I said earlier, the economic value added is a financial performance based on residual wealth, calculated by deducting cost of capital from operating profit. So what I did was I took the last 12 months of economic value added, the EVA, of each of the top 5 companies, and listed them in Excel. No, I did not sort them, I'm sorry, but I did put ranking numbers next to the numbers for you. So as you can see, Deere and Company came in first. Coca-Cola was second. Monster Beverage was third. Intuit was fourth, and CB&I was fifth. So, in looking at this, what does it? I guess what does it kind of mean? Well, let's take from the top. Deere was ranked number one. Seemed to be economically successful, over the past few years to hold a high EVA. Second was Coke, not far behind Deere at all, and has proven to have economic success. Monster came in third. Although all ratios seem to be high, Monster doesn't compare to the top two companies, the EVA. Intuit, economic profit is positive, but to me, I really think it could be better. CB&I was definitely the lowest player whenever it came to the EVA comparison. Now, the profit margin is how much a company keeps in earnings for every dollar it sells, of sales. So, again, I listed these, the companies, top 5 companies in Excel, and I didn't rank them. Let's see, number 1, the first on profit margin was Coca-Cola at 20.6. Second was Monster Beverage, very, very close to Coke at 20.5. Third was Deere and Company, much lower, but still positive, still good, at 8.9. CB&I was 4.3. They were fourth, and Intuit shows a negative 5.4, which is not good. So, Coca-Cola's high PM shows high profit per dollar in sales. Monster is very close to Coke, showing high profit per dollar in sales. Deere is a positive number, but it was substantially less than the others. CB&I, positive, yet low profit margin, which would lead me to believe that they may need to make a few adjustments. And Intuit obviously needs to make adjustments. They have a negative profit margin, so that doesn't show positive profit for the company. So, in conclusion, and to wrap up this interesting presentation, I'm going to pick Monster. Monster, they win my vote as the top company. And I'll go into a few points as to why and kind of recap the presentation. Their ROE was the highest of the 18 analyzed companies. They had the highest operating margin of the top 5 companies. They had the best asset turnover, which is really key. Showing asset management for their company. Sufficient leverage, showing moderate risk, making them profit. Their EVA, it could use some growth, but overall, they're right there in the middle of the pack. So it doesn't really concern me too much, as long as they're in the race. The profit margin was nearly the highest, and it shows them to be a profitable company over the length of time that they've been in business. So I hope you enjoyed it. Not as many jokes on this one because it's 8:30, and I'm still at work working on this project. I'm a dedicated student. All right, thanks for watching.